As China's 15th five-year plan unveils a new blueprint for growth, what signals are shaping a leading global economy? And where are the opportunities ahead? Invest in China, a special series on BizTalk. In this final episode, we turn to China's latest earnings season, where resilience is emerging. As of April 22nd, out of nearly 200 A-share companies reporting their first quarter earnings forecast, over 80% companies expect profit growth. Strength is emerging across key sectors, from artificial intelligence and semiconductors to non-ferrous metals and lithium battery storage. New growth drivers are coming into focus. What's powering these, and what do they reveal about China's next phase of high-quality development?
When you ask, look at the relatives around the world, what seems better placed than others? Yes, Chinese energy firms do look a lot more appealing than others.
For global investors, the Chinese market is definitely a market to be looking at for diversification benefits.
Invest in China, a special series on BizTalk.
And welcome everyone to this edition of BizTalk. I'm Michael Wang here in Beijing. Well, Chinese companies are reporting earnings and the numbers are turning heads. Corporate profits in many sectors are strong. Factory gate prices are rising for the first time in years, and China's most innovative companies are making their mark on the global stage. Is this the beginning of a sustained earnings recovery? And with Chinese stocks trading at a discount to global peers, is now the moment for international investors to take a closer look? For more on China's earnings season, I'm joined by Hong Hao, Managing Partner and Chief Investment Officer at Lotus Asset Management, and David Scutt, Senior Market Analyst at Forex.com by StoneX Group. David, Hao, welcome to the program. Hao, let me start with you. So as of mid-April, more than 80% of A-share companies reported positive earnings for full year 2025. It's still, of course, early days for the A-share companies that did give earnings guidance for Q1 2026, but you also have over 80% reporting positive outlooks, the ones that did report so far. So give us your overall take in terms of how you're viewing corporate earnings for 2025 and how first quarter 26 earnings are shaping up.
Yeah, I think the Q1 earnings tend to be very strong, because in the first quarter this year, the Chinese economy performed very well. And also we're seeing lifting in price pressure in the upstream sectors as well. So many of the upstream markets and upstream companies are enjoying expanding profit margin at this stage. And the trend is looking to be continuing in the coming quarters. So I think in general, the upstream sectors, except for some hedging losses, the underlying profit growth tend to be quite strong. Consumption still lagging, but I think consumption is picking up. Some of the leading steers in the Chinese consumption companies, is reporting price increase in the coming quarters as well. So I think once the upstream pricing pressures are starting to be lifted, and also upstream expanding margins tend to be passed on to the downstream sectors. So I would say that in the coming quarters, the strengths in the upstream sectors will more likely than not pass on to downstream sectors. I think in the overseas market, we're seeing rather strong earnings growth coming from the tech companies as well. But for much of the earnings improvement in the S&P components, more than half of the earnings growth is coming from one company, which is the Micron, which is a memory semiconductor chip company. And then I think for the top 10 earnings growth contributor, 5 or 6 out of 10, they're coming from the chip sectors as well. So it makes the earnings improvement rather concentrated, and it sort of masks the weakness in other sectors as well. We think that this trend is more likely than not going to continue because the inflationary pressure in the U.S. economy is hindering U.S. consumption.
Yeah. And David, what do you think about this topic?
G'day, Michael. Great to be here. Look, it's lots of positive momentum, not just in Chinese earnings, but earnings across the Asia Pacific. And one thing that really stands out, though, is just the uncertainty that comes about as a result of the Iran war. There was strong momentum in the global economy. You could see that reflected in bond yields. You could see it reflected in the shape of bond curves. And that was really filtering through to expectations for earnings of what we saw in Chinese companies. And that is still playing out. But the big caveat now is that we're not exactly sure how this scenario in the Gulf of Hormuz will play out and what will it mean for more cyclical orientated markets such as those in China.
How resilient have Chinese equities been able to weather these external shocks so far, be it the Middle East conflict or geopolitical tensions?
I think the Chinese market has been rather resilient. During the course of the war so far, I think the Chinese market is actually going substantially less down than the regional market. The Korean market and also the Japanese market at one stage is down close to 20%. And for a few trading days in between, the Korean market actually has a circuit breaker incident as well. So I think I would say that, the Chinese market and also the Chinese Hong Kong market has been rather resilient. I think till today, we more or less recoup much of the losses since the beginning of the war. And I think the market player here seems to be believing that, the war will end sooner or later. So I think, people are back to, looking for opportunities in the market, especially the tech sector, which has been under rather substantial pressure since the war beginning, is starting to rebound. And also the upstream sectors as well, because of the rather strong earnings growth we discussed just now, and also rebounding in general in the commodity sectors. So I think the upstream sectors are bouncing back very strongly, and some of the upstream sectors already recuperate much of the loss since the beginning of the war and is making new high. So I would say that, in general, the Chinese market is exhibiting very, very resilient performance, and also the correlation between the Chinese market and the global market is actually less, not more. So I think, for global investors, the Chinese market is definitely a market to be looking at for diversification benefits.
Hao, let me ask you a little bit more about these upstream companies, Hao, what it might mean for Chinese equities more broadly, because we are seeing, of course, signs of producer price reflation with China's factory gate prices turning positive for the first time in nearly 3.5 years for March. It is, of course, just 1 month's data, but historically, A shares have performed well in PPI reflationary environments. Do you think that we are perhaps at the start of another upswing in PPI? And if so, how supportive is it broadly for Chinese equities?
Yeah, I think the PPI is actually trending upwards since the end of the third quarter last year. Since the end of the third quarter last year, we're actually seeing, for example, iron ore, which has been under a rather substantial downward pressure, is actually rebounding as well. And also last week, China announced that, it would sort of lessen the import restriction from Australia. So iron ore is actually one of the biggest exports for Australia. So I think, in general, upstream sectors has been exhibiting upward price pressure since late last year. And we think more likely than not, this pricing trend would continue. And also don't forget, there was a very strong policy initiative by the Chinese government, which is trying to anti the involution activities in some of the platform companies. So I think, ever since then, and then also, since a few rounds of discussion with top managements of many of the big platform companies, the anti-competitive or the ultra competitive behavior competition in the sector is actually lessening. So we're seeing, consumer price is actually bouncing back as well in the downstream sectors. So I would say overall, we should expect this pricing trend to continue. And once the upward price pressure passes down onto the downstream consumption sectors, you will see differentials between CPI and PPI starting to expand. And then, what that means is that, the downstream companies will have much better profit margin as well. That is, something that we really want to see. So, the trend is more likely than not will continue in the coming quarters. We think, the PPI uptrend will pass on to CPI as well in the coming quarters.
And David, how compelling do you think are A shares as a diversification play for institutional investors right now?
China's the kind of market that you have to have an allocation to regardless. It's such an important market and it's such a conduit into EM sentiment as well. At this point in time, though, because of what's going on in Iran, we've seen a preference for those growthier markets where there's more certainty when it comes to earnings. That's why you've seen the likes of the Nikkei. That's why you've seen the likes of the Kospi in South Korea outperform on a relatively short time frame. So when it comes to the Chinese market, to go and get excited about the prospects for earnings recovery and outperformance relative to regional peers, I would love to go and see some much greater certainty when it comes to the economic environment, particularly when it comes to not only geopolitical situation in the Gulf, but also the situation between China and the United States when it comes to trade.
Here on BizTalk, we connect the dots, shedding light on the real stories behind the economic landscape. To better understand China's dynamism and the economies and rhythms of business, propelling new drivers of growth.
China.
BizTalk, your window into China and the global economy. Only on BizTalk.
Each day, there are millions of stories. Each one can open new perspectives, new possibilities. Wherever you look, we are there to see, discover, explore. We put the pieces together to find what really matters to you, all around the world, all around the clock. Our reporters are at home across the globe. From our headquarters in Beijing and production centers in Washington, Nairobi, and London. Stories from across the globe, reaching people across the globe. CGTN. See the difference.
How in terms of where you're seeing earnings growth potential may be, because the market consensus forecasts for EPS growth of MSCI China, that's around 17% for this year. It's around 23% for the CSI 300. So where do you currently stand with respect to that consensus level?
Yeah, I think one should be too surprised to see earnings growth continue to be strong. On one hand, you're getting a lift from a rising inflation, and then at the same time, we're getting a lift from the policy support as well. Just now we discussed, how strong the GDP growth in the first quarter has been for China. So I think, for companies operating in this space, then they should definitely benefit from these two general trends. And also further to that, the MSCI China index has quite a bit of companies coming from Hong Kong. And needless to say, the Chinese Hong Kong economy has been performing very well since late last year, and this year Hong Kong is also reporting an expansionary fiscal budget as well, and that is going to help. So if you're in Hong Kong, you can really feel the activities starting to heat up. So I think one should be expecting north of 10 to 15% earnings growth this year. I think the consensus earnings growth might be a little bit on the high side, but I think one should be too surprised to see around 10 to 15% earnings growth for the MSCI component companies this year.
David, how are you looking at this?
Look, being honest, particularly when it comes to the cyclical areas, the CSI 300, the tech sector, I'm very assured that what we're looking at here is a structural shift for the time being. So the growth that you're seeing coming through there, I believe, is going to be very, very strong. Where the uncertainty lies as to what it means to the cyclical parts of the market. I know that there's been a lot of excitement about the increase in PPI, which has seen the year-on-year rate go and an increase in positive territory the first time in several years. But when you strip back all the parts for that, it really was just purely an energy story. So I'm not as excited as some other analysts there when it comes to the potential for those upstream industrial sectors as well. And then also what it means for the likes of financials, very, very big constituency there in the mainland markets in particular. So when I put that into the equation, I feel much more comfortable owning Chinese tech than I would be looking to go and some of those cyclical names at this point. At some stage though, when we get certainty, and hopefully it will be for the better, there will be a lot of attractive names out there that are heavily discounted relative to other markets around the world though.
Yeah, let me ask you about valuations, and I'm wondering whether or not if we do see an upswing in Chinese tech stocks, what that might mean for Chinese companies overall, because Chinese stocks right now are trading at maybe 11 to 14 times forward earnings, depending on whether you look at the onshore or offshore market. The S&P 500 trades at over 21 times, but the consensus earnings growth forecasts for Chinese and U.S. equities, I would say, are relatively comparable. So does this make the case for potentially more interest in Chinese equities as we close that valuation gap and as earnings growth estimates are about the same for China and U.S. right now?
It's heavily discounted. It's heavily discounted for a reason. It's not just because of the technological war that we're seeing between China and the United States, but also what's going to happen in this very key meeting that's coming up between two presidents of both nations. That's going to be a very key point in this particular dichotomy. What's going to go and outperform? When you look at the other valuation gap, there is a clear valuation gap. If we can go and get both the United States and China on the same page and at least have a relatively palatable relationship, where there's not tit-for-tat tariffs coming through every second week or so, that would go and be a net tailwind for Chinese equities relative to the US, particularly at the valuation increase that we've seen in the US over the past month or so.
How earnings of Chinese software companies have been strong so far in Q1 as well. Is the AI earnings story in China, you think, just getting started? And which part of the AI ecosystem do you think has the most earnings upside from here?
I think the AI story is, getting accelerating from here. Since last year, for example, one of the major Chinese semiconductor company, which is labeled the Chinese NVIDIA, is enjoying a very substantial earnings growth. It's actually becoming profitable from a loss-making company. So I think as a result, the company's stock price has been surging. One should be too surprised to see the demand for semiconductor chips continue to drive the earnings growth trajectory in many of these companies. And also, I think many people may have missed this point. So the Chinese growth is still going very strong. And one of the biggest component for the Chinese export growth is actually semiconductor. In terms of value exported, the semiconductor chips has contributed the most to Chinese export growth since late last year, and this trend should continue. So I think, in general, AI is all about now, people has seen it rather clearly. It's all about, chips, especially memory chips, because now you have to give AI memory, for it to perform well. And also it's about energy as well. So I think in general, the tech sector will be one of the key sector for foreign investors focus on, because it's riding the AI wave, and also it's getting the policy support from the government as well.
Yeah. Let me ask you about a few other subsectors, because China, of course, has built quite a commanding lead when it comes to clean energy, solar panels, EVs, batteries, wind power. Now, the 15th five-year plan, it doubles down on that foundation by bringing in even more wind, especially really far away offshore wind, solar, hydro, energy storage, green hydrogen, that wants to be developed by China as well. How much of China's earnings growth story over the next 5 years, maybe even over the next 10 years, do you think, can be driven by the clean energy story?
Yeah, well, I think the clean energy is already helping the Chinese economy during this war. The Chinese market is less affected by the war, and I think more or less, the Chinese economy is running, going as she goes. So I think, going forward, we will see more and more new electricity generation capacity being installed in the new energy sector. Already, I think the new installation capacity from the new energy sector is higher than the traditional energy already. Right? So more than 50% of the new installation is for the new energy sector, right? So which is phenomenal. So I think, given the impact from the war, I think the story of new energy going forward is getting stronger, not weaker. The significance of having a sustainable new energy sector is becoming more powerful, more convincing, not less. In the past few years, China has built up tremendous capacity in the new energy sector. The solar panel price in the new energy sector is plunging by more than 90% already, because of the concern of overcapacity. But that is building on the demand from the domestic Chinese economy.
David, because we know Chinese energy companies, they had outstanding earnings performance in 2025 with tensions in the Middle East creating a lot of uncertainty around global oil supplies. You've seen relative resilience here in China as the country has been deliberately building up energy security buffers for a long time. How well insulated do you think is the Chinese economy and its energy companies from an oil price shock? And does that resilience, you think, potentially make Chinese energy companies a relatively safer investment destination right now compared to its peers?
Arguably, yes. Both from a price perspective, a cushion from the price shock equation, and also a supply shock equation where other parts of the world don't have the same buffers in place. So when you ask, look at the relatives around the world, what seems better placed than others? Yes, Chinese energy firms do look a lot more appealing than others.
Let me ask you about a potential other driver when it comes to earnings growth, David, because China saw robust foreign trade in 2025, and that momentum, I think, has continued into Q1 2026 as well. As Chinese companies increasingly go global, how much do you think will overseas expansion support earnings growth over the next few years? Can going global, you think, become the structural driver of earnings growth?
In short, probably not at this point in time, not under the current US president. I don't think that will be palatable for several of the Western nations. So I think it's one of those areas where there's definitely a case to go and make overseas investment, but I reckon there's probably more opportunities in the domestic market right now, particularly around that household and consumer story to go and focus on.
Hao, let me ask you a bit more about where you are, because Hong Kong topped the global IPO rankings last year, and that momentum is continuing into 2026 as well. We've got, around 400 companies in the pipeline for listings in Hong Kong, many of them in the hard technology and new economy sectors. So as China's most innovative companies increasingly choose Hong Kong as their listing venue, how compelling do you think is Hong Kong as an investment destination for international investors seeking more exposure to China's new economy growth story?
Yeah, I think Hong Kong is a natural choice. I think last year, Hong Kong has already registered, very strong IPO performance. It's actually the #1 IPO destination for fundraising. So I think this year, will be even more stronger than last year. I think international investors realize that, if you want to invest in AI, there's two camps that is leading the way. One is the US camp, which is relying on a closed-end development. Many of the US models, they are proprietary and they are limited only to the US companies and their alliances. But I think the Chinese model is entirely different from the US in the sense that it's an open-end model. So I think, Chinese companies rely on open source to develop their models and their chips. And so I think as a result, the Chinese companies are catching up fast, because you're aggregating the collective intelligence from the crowd, not just, the US scientists. And the Chinese scientists excelled in, mathematics and also in logic. So, and the Chinese government has a tremendous policy backing for this sector as well. So that's why, we're seeing more and more high-tech AI Chinese companies coming up at a breakneck speed. So, this year, for the 400 companies that is going to be listed in Hong Kong, many of them are, AI companies, tech hardware companies, and also CPOs, which is the new drug development biotech companies. In many of these sectors, China has a cost advantage and also is catching up really fast with the US technology.
Hao, so China's 5-year plans, they have a strong track record of directing capital and policy support toward priority sectors. And the companies in those sectors have historically outperformed the broader market by quite a lot. The 15th 5-year plan is now in place. It runs until 2030. If you were to pick 2 or 3 subsectors from that blueprint that you think offer the most compelling earnings growth potential, what do you think they would be?
Yeah, I would say AI, new energy, and also healthcare. I think AI, we spend quite a bit of time discussed just now, and new energy. Right? So both sectors are going from domestic to foreign demand, and the trend is starting to explode. I think healthcare, is one of the names or one of the sectors that is being, less discussed in the market. But already this year, the new drug sector, the drug development companies in Hong Kong is making a tremendous comeback. There's already a very substantial rebound in the stock price. So I think, these three sectors also, they are emphasis of the 15th five-year plan, with the tech and also with consumption and also with healthcare. These sectors, they will offer tremendous opportunities, for international and domestic investors going forward.
Yeah. David, same question to you.
Tech and healthcare, both structural at this point in time.
Finally, David, when you step back and you look at the overall picture, I think we've covered a lot of ground. How would you characterize the overall risk-reward profile of Chinese companies right now? And for an international investor that might be sitting on the sidelines, what do you think might be the single most compelling reason to take a closer look at Chinese equities right now?
They're still very heavily discounted and still a lot of underweights around there when it comes to fund managers from outside of mainland China and Hong Kong. When I pay very close attention to the signals coming through from the bond market as well. If you look at the period of underperformance we've seen over the course of the first quarter relative to other markets around the world, we had a really strong flattening of the curve, a late cycle kind of move, and that weighed on Chinese markets relative to others around the region. So when I step back, I can see there's very, very fleeting evidence that maybe that's starting to go and turn. As a cyclical market as well, that is a positive, should it continue in China.
So for an international investor that might be sitting on the sidelines, sitting on the fence about Chinese equities, what do you think is the single most compelling reason to take a closer look at Chinese equities right now?
Yeah, I think people underestimated the Chinese market substantially, and also it has been ignored for a number of years. I think many people back then the popular belief about the Chinese market is that Chinese is uninvestable because the market is heavily regulated by the government. But despite all this misunderstanding and misconception, the Chinese market actually offered tremendous opportunities for investors in the past 2 years, and especially in Hong Kong. If you look at many of the Chinese AI companies, tech companies, semiconductor companies, healthcare companies, consumption companies, Labubu, for example, all of them are offering tremendous opportunity for international investors. And because of the misconception by international investors in the past few years, everyone is substantially underweight China. So I think China is misconceived and substantially underowned, and almost everyone in the world is underowned China in his or her portfolio, and everyone's portfolio is heavily concentrated in the US. So I think it's time for a change.
All right, we are going to leave it there. Hao, David, many thanks for your insights. Our thanks to Hao Hong of Lotus Asset Management and David Scutt of Forex.com by StoneX Group for sharing their insights with us today. And that's going to do it for this edition of BizTalk here on CGTN. I'm Michael Wang here in Beijing. Thanks for joining us. We'll see you again next time.